Welcome to This Explainer. I'm absolutely thrilled to have you here because today we're unpacking a literally once in a generation shift in how our money gets taxed. We are finally saying a permanent goodbye to the 60-year-old Income Tax Act of 1961, and we're stepping right into the brand new reality of the Income Tax Act 2025, which comes into full force on April 1, 2026. And look, this isn't just a minor update with a few tweaked percentages. It is a complete, top-to-bottom structural overhaul of the entire system. But don't worry, my goal today is to make this incredibly complex transition totally understandable, practical, and honestly, maybe even a little bit fascinating.
So let me ask you a really direct question. Which tax law is actually going to apply to your very next paycheck? Think about it. If you get paid at the end of March versus the end of April in 2026, do you know exactly how these new laws are going to hit your immediate take-home pay? Because the reality is, the rules of the game are changing overnight. And if you aren't prepared, you or your employer might end up on the wrong side of compliance. So let's make sure that doesn't happen.
All right, here's our wallet-first roadmap for today. 1. The new tax slabs. 2. Surviving the April transition. 3. TDS and TCS rule changes. 4. The non-filer penalty trap. And 5. Less jail and graded fees. Let's dive in. Section 1. The new tax slabs. More money in your pocket.
Okay, for the assessment year 2026-2027, the tax rates have gotten a major, much-needed makeover for sheer simplicity. First off, income up to 4 lakh rupees is now completely exempt from tax, 0%. From there, it scales up beautifully in simple 4 lakh increments. So you're looking at 5% up to 8 lakhs, 10% up to 12 lakhs, all the way up to the maximum marginal rate of 30%, which now only kicks in for income exceeding 24 lakh rupees.
And speaking of huge wins, the government is making a massive push to maximize relief for the middle class here. Under Section 87A, the income threshold for claiming a tax rebate has skyrocketed from 7 lakhs to a massive 12 lakhs. Plus, the maximum rebate amount itself just jumped from 25,000 to 60,000 rupees. Basically, if you opt for this new tax regime and your eligible income is up to 12 lakhs, your effective tax liability essentially zeroes out. The one crucial caveat to remember, though, is that incomes chargeable at special rates, like certain capital gains, are excluded when calculating the specific 87A rebate. But still, this is an absolute game changer for everyday earners. Section 2. The April transition. Navigating the crossover. Now, the absolute key here is understanding what they call the event of credit or payment rule. The Income Tax Department has been very explicit. The act governing your TDS obligations during this transition month depends entirely on what happens first. Is it the event of crediting the money in the accounting books or the actual physical payment? If either of those happens on or before March 31, 2026, you're still using the old 1961 Act. But if the earliest event happens on or after April 1, 2026, boom, the new 2025 Act applies. We really have to cross this bridge carefully so payroll departments don't accidentally get slammed with penalties for applying the wrong law. Let's ground this in a real-world scenario. Say your salary for the month of March 2026 is paid on March 31st. That paycheck is governed entirely by the old Income Tax Act of 1961. Why? Because the payment occurred before April 1st. But your very next paycheck, your April 2026 salary, paid on April 30th, falls strictly under the new Income Tax Act of 2025. The exact date the money hits the bank or gets credited in the employer's books is the ultimate decider. So employers must completely reset their TDS computations starting April 1st, applying the new Section 392(1) instead of the old Section 192. And here is a massive, practical heads up for when you log into your HR portals this coming year. Old terminology, it's out. For tax year 2026-27, your investment declarations have to reference the new law. You know that famous Section 80C we've literally all leaned on for decades? Well, say goodbye, because that is now replaced by Schedule X VREAD with Section 123 of the new Act. If your company's payroll system isn't updated with this new section numbering, things are going to get super messy very quickly. Section 3. TDS and TCS rule changes. Daily financial impacts. Okay, there is some massive relief here for anyone booking a trip abroad. Previously, if you bought an overseas tour package, you'd get hit with a 5% TCS up to 10 lakhs and a totally staggering 20% TCS if you went over 10 lakhs. The new act, it completely removes that threshold and drops the rate to a flat 2%. And it's a similar story if you're sending money overseas for education or medical treatment under the liberalized remittance scheme. That rate has also dropped just 2%.
traveling and studying abroad just got significantly less taxing on your upfront cash flow.
Plus, the government is deliberately leaving more money up front in the hands of freelancers, landlords, and investors by raising the thresholds before TDS even kicks in. TDS on dividends won't happen until you cross 10,000 rupees. TDS on rent is now pushed to 50,000 rupees per month. Insurance commissions can go up to 20,000 rupees before TDS hits. And for all you freelancers out there, royalties and professional fees only attract TDS after you hit 50,000 rupees. This is a very intentional move to reduce the daily compliance burden for smaller transactions.
Section 4. The non-filer penalty trap. Consider this a stark warning.
20%. Yeah, you heard that right. That is the brutally punishing TDS rate you could be facing if you fall into the Section 206AB trap. Normally, standard TDS sections range from, 1% to 10%? But if you get flagged in the system, your corporate clients are legally bound to withhold your tax at double the standard rate, or 5%, whichever's higher. So for an IT consultant who's used to a 10% deduction, that means a sudden, painful jump to 20%. That's a massive chunk of your cash flow acting as an interest-free loan to the government simply because you didn't file on time.
So who exactly gets slapped with this 20% rate? Well, you get caught if the system designates you as a specified person. And this happens if you meet two conditions simultaneously. First, you miss the income tax return deadline for the previous year. And second, the total TDS and TCS collected in your name was 50,000 rupees or more in that exact same year. And honestly, here's the scariest part. Corporate accounts departments don't even have to ask you if you filed. They use a live, centralized compliance check portal to just look up your PAN. Your non-compliance is instantly visible to the companies paying you.
Now, if you do find yourself stuck on this specified person list, you can't just pick up the phone and complain to the tax department to get it fixed. The removal is entirely automated. Step 1, you've got to immediately file your overdue return or an updated return, which is known as ITRU. Step 2, you literally just have to wait for the system to process that return. And step 3, the portal periodically auto-updates. So once it finally registers your filing, your status flips back to normal, and you can finally tell your clients to stop deducting that painful 20%.
Section 5. Less jail, graded fees. New tax offenses laws.
Under the old 1961 law, general offenses could actually hit you with rigorous imprisonment for up to 7 years. Pretty intense, right? Well, the new law completely decriminalizes a lot of this, replacing it with simple imprisonment for a maximum of 2 years, or in a lot of cases, just a fine. In fact, if the tax evaded is under 10 lakh rupees, the new rules prescribe only a mandatory fine with absolutely no imprisonment whatsoever. It is a much, much more proportionate response.
To quote the Finance Bill summary exactly, technical defaults are now converted to a graded fee depending upon the period of delay. So what does that actually mean for you? It means if you're just late submitting an audit report or you miss a transfer pricing report deadline, you aren't treated like a hardened criminal facing arbitrary, crazy penalties. Instead, there's a structured fee schedule, like say 75,000 rupees for a certain delay, jumping to 1.5 lakhs if you delay it even further. It's predictable, and it focuses on financial restitution rather than prosecution for simple compliance slips.
Before we wrap this all up, I definitely want to point out one vital new lifeline they've introduced, Fast DS 2026. If you have undisclosed foreign assets or foreign-sourced income, this is a time-bound scheme allowing you to come clean. By declaring these assets and paying the requisite tax or fee, you can gain limited immunity from the incredibly severe penalties in prosecution under the Black Money Act. It's a crucial window of opportunity for folks who might have just made inadvertent errors in the past.
So, as we look out at the landscape of this brand new Income Tax Act 2025, I gotta leave you with this. Are your payroll and personal finances truly ready for that April 1st switchover? From shifting tax slabs and brand new deduction codes to the harsh realities of that non-filer penalty trap, the rules of your money are fundamentally changing. Please don't wait until the transition is already happening. Update your systems, file your returns, and take charge of your financial compliance today. Thank you so much for joining me on this explainer, and keep learning.